Is the stock market just for rich people? Hey, I'm Chris, and this is The Money Translator. I'm a communications professional with over a decade of experience explaining complicated information in a way that makes sense for real humans. And today we're going to answer that question. Is the stock market just for rich people? And look, it's a fair question because for a lot of people, investing feels like this thing that other people do. Other people have an investment portfolio. Other people have a second or third house. And if you've never really had someone to sit down and explain that to you, if investing wasn't a language that was spoken in your house, you won't have that confidence and you won't know what it is. And it's easy to assume that a lot of people know what the stock market is and how it works and why our whole economy is basically built on it. So if you are interested in learning the answer to that question, stick around, hit subscribe, and let's answer the question. All right, simple truth is yes. At least historically, the stock market was designed for people who already had power, who already had wealth, who already had connections. Sorry to break it to you. I know it's a huge surprise that rich and powerful people started something that you didn't have access to. But what is a stock market? Well, it's in the name. It is a market for stocks. Think of a stock market like a supermarket. So you walk into a supermarket and there's products on the shelves and you can pick something off, you can buy it and then you leave. So instead of products, think about little pieces of companies. So you're wandering out in the supermarket and you can buy a little piece of Tesla, you can buy a little piece of Apple, and you own it. You own a slice of that company. Now, it may be a really, really small slice, or it might be a really, really big slice, but you have the ability to own part of that company. In the 1600s, I believe, the very first company that was sold as part of a stock market was the Dutch East India Trading Company. They were a shipping company who would send out ships to get spices and goods from places, bring them back to the Netherlands and sell them for a profit. Now, if you owned a piece of this company, your shares in the company would become more valuable as they sold these spices, right? So it makes sense. You sell the spices, you make a lot of money, your company gets more valuable because they can get more of the thing that people are selling and buying, and therefore your slice of the company becomes more valuable. If the ship sank and the spices, alas, went into the ocean, so did your investment. All the way up into the 80s and 90s even, you would get a physical piece of paper that said you owned a piece of this company. So they were like money in a sense. People would lock them away in their safes with their bars of gold and their wads of cash too. You just couldn't walk off the street and buy these shares. Like I said, you had to be connected, you had to be rich, you had to be powerful, you probably had to be a man. Fast forward to the 1900s, all good things must come to a sudden crash, which is exactly what happened in 1929 in something called the Great Depression. Now, this was caused by a massive crash in the stock market. Businesses lost hundreds of millions of dollars in value overnight. There is so much that goes into the equation of whether the stock price goes up and down, but it really does come down to one word, and that is expectation. Stock prices really do move on what people think is going to happen. If a company launches something big, like a new product, or they make a solid profit like we've talked about, even if it just has a really good success story, that can move a stock, and sometimes it can move it 10, 20, 50, 100%. However, a stock can also move the other way. So let's say the company has a really bad earnings. The CEO might have a scandal. He might get caught at a Coldplay concert with his HR director. There might be a global recession or a global pandemic. The confidence of people drops, the value of the company drops, people sell their stock. So you can buy a stock, but you can also sell it, and people panic and they sell it. And the more things sell, the further down the price goes. I just did the Ross Geller. It's part logic, It's part emotion, it's part mathematics, it's part mood, it's part vibes. It's a wild place. But over time, generally, the companies who are consistent, who make a product that everyone needs or wants, they're the ones that tend to grow and deliver value over time, and therefore your investment. After the 1929 crash, millions of people lost their savings, and the governments of the day had to bring in protections and legislation or pieces of law to help protect both probably the markets primarily, but also the people who are affected by the losses of the market. So the markets got safer, put that in quotation marks, they got safer, but they got more complicated, they got more dense. There was a lot more laws put around how you could trade stocks, how you could exchange your money for shares in a company. So everything became far more professionalized and legalized in a way that made it, again, far more inaccessible for the everyday person. Fast forward to the 90s, now things are starting to get a little bit more, modern is not the right word, but you still have high costs and high barriers to access. So, you're learning about stock prices from the newspaper, you're faxing or calling your broker. You couldn't just log in. I mean, this is kind of pre-internet, right? You couldn't log in and buy a share. You had to go through your broker. To buy a share was actually really expensive. It might be $50, $100, $200 per share. We're so used to things being instant that it's hard to imagine waiting days for someone to get back to you about whether your trade was successful or not. But as you can see, that the system has evolved over time and has slowly let people in. And that shift started with the internet. It revolutionized stock trading. I mean, today you can invest with the smartphone. You just pull it out of your pocket. You've got access to all of the quotes that would take till the next day to come out of the newspaper. You've got information that no one had. And we no longer really have brokers in the sense of a person who we give our orders to, although some people may still do that. But our brokers are now our apps. They facilitate the trade between us and the exchange, and that exchange is open to us now. So that makes investing somewhat of a self-serve model. You can kind of be a one-person band if you want. So the concepts are there. If you're looking at trading now versus what these trading of shares looked like back then, the concepts are really similar. But there are options for people who don't have a lot of money but want to invest safely, and these are called index funds. These are really boring, but I would argue are incredibly valuable for people who feel left out and want to be able to invest their money and to see it grow. And index funds are a really good way for normal everyday people to do that. There are tons of index funds, so many, I couldn't list them, but one of the main ones you probably have heard about, even if you don't know what it means, is the S&P 500. So this is an index that tracks the top 500 companies in the United States. And what an index fund allows you to do is actually buy a piece of all of these companies at once. So instead of buying one company, you're now buying shares in 500 different companies, and your money, let's say you're putting in $1,000, suddenly gets more diversified. Diversification really is just not putting all your eggs into one basket. Over time, investing into index funds, you can grow your money. So that's another way that investing has become more accessible to the everyday person. You can now buy these index funds. It's not just the S&P 500, but there's lots of different index funds. So now the main barrier to the stock market isn't access, because we've got access now. There's so many tools for us to participate in this market, which is really good. But the problem is understanding. It's understanding why investing is important. I did a video about 10 financial terms that everyday people may have heard but not understood, and I want to encourage you to check that out. I'll put it in the description below. But One of them was talking about income and how we work a job and that's active income, right? It costs us our time. You know, I've got to go to my job and put 8 hours in order to be paid for that 8 hours, but I'm not getting that time back. What investing does, it's a way for our income to grow without us having to sell our time. So like give up our time, because really, again, it's the only thing that we can't get back. So investing is a way for ordinary people to recapture that really precious resource. And the more we can invest, the more potential we have to gain that back, which is why investing is something that allows us to take a little bit of power back. So, is the stock market just for rich people? Well, no, with some strings. I think there are still aspects to the market which are incredibly, incredibly gated and corrupt. You know, you only have to look at the 2008 financial crisis to see just how badly people who make money for a living can behave when it comes to preserving that living. And if you haven't seen it, I highly recommend The Big Short. It's an incredible movie that talks about the 2008 financial crisis. So look, it's not all rosy is what I'm trying to say, but the things that used to prevent you from participating in this activity, things like brokers, minimum amounts that you could buy, high costs of trading, the jargon even, that's mostly been removed. You can now start a stock position from your phone. You can start with some spare change. You can invest in little slices of companies, and you can build a portfolio passively. You don't have to pick individual stocks. Can you invest without being rich? Yes, you can. Investing is not a silver bullet that's going to completely change your life overnight. It's not a lottery. Social media is an incredibly curated version of reality. You're only seeing everyone's best. And that goes for stock trades too. If you wander over to Reddit and have a look at some of the insane stock market plays on something like Wall Street Bets, you think that anyone could make $1 million gain on a stock, but it's like seeing a lottery winner post their winning lottery ticket. It's ridiculous to think that you'll be able to pick the next stock, but it is an opportunity. And I guess us everyday ordinary people are always looking for opportunities to make our money work for us. You know, we don't want to be selling our time forever, and it's the only thing that we can't get back. And so seeing the stock market as a way to kind of multiply what we already have is actually really appealing. And I would encourage you, if it's something that interests you, just to dip your toes in. You don't have to put your life savings into the stock market. You can invest $5, $10, see how it works, see what kind of returns you can make with a small amount, and then just gradually increase or consistently investing over time to get more comfortable with your money being put to work. If we really want financial freedom, part of the ingredient of getting there is investing, is putting money to work. So if this was the first time investing made any sort of sense to you, then hit subscribe, because I love to explain information in a way that makes sense for real humans. I hope this was helpful for you. Leave me a comment below. I'd love to hear about what investing means to you, what it represents. I'm Chris, this is the Money Translator, and I'll see you on the next video.